Good afternoon, everyone. Welcome back to the Schwab YouTube coaching channel for our next topic after the close. I am your host, Kevin Horner. I join you from a little chilly fall-like Denver, Colorado, but I'm glad to be here with all of you nonetheless. So thanks for sticking with me after the close here today. So now, traditionally, many of you traders are out there watching the market day to day throughout the day, hour to hour, minute to minute sometimes, and many of you don't have the opportunity to do that. And so to this class after the close, the whole goal here is to give you some steps that you might consider in looking toward the subsequent days of this week for what could amount to trade opportunities for you. So what we're thinking about it, of course, here in the class is from an example basis, and what we're going to cover is the process by which you might review the market and get a handle on those potential opportunities. Now, today, we had a little bit of broad market weakness, and I thought it was a good opportunity to remind us that beyond what we've been seeing for the last few months, there are bearish trends in the market. And so I've built some bearish screens for us to review. Those are some scans that I'll be able to share with you as well. And then we will build an example trade or two in this class, wrap up with a review of our example portfolio, which might need to be addressed heading into the next couple of days. So that's kind of the lay of the land for today's class. We'll say hi to Barb Armstrong in the chat this afternoon. She'll get to questions and comments that I'm unable to get to, but I'll keep an eye on things for you there nonetheless. If you're not already doing so, a great way to engage with us coaches, aside of the classes we offer you here on the YouTube channel, is on X. You can follow us there, Barb Armstrong CS and Kevin Horner CS. It's a good way to follow along and see what we're up to throughout the week as well. So if today's conversation goes well for you too, don't forget to get a thumbs up down below for me. We're going to get this class reviewed and into the archive shortly afterward. So that thumbs up helps us out in the YouTube algorithm, and we can get this class out to more interested parties. So with that, let's get to our disclosures so that I can talk about some of the fun stuff that I'm sure you're all here for. So I'll remind you that our discussion is exclusively informational and educational. We do not make recommendations. We do not make endorsements for a specific approach to trading the market here. Additionally, while we'll talk technical analysis, please remember that technical analysis is merely a portion of your decision-making process. It is not something we encourage you to base your decisions on exclusively. So please keep that in mind. As part of your decision-making puzzle, so to speak, it's important that you're basing decisions off more than just one or two main concepts. So balance a few different things in your head simultaneously can be helpful. Additionally, today, it's important to know options carry a higher level of risk, are not appropriate for all traders. You'll need to be familiar with the characteristics and risks of standardized option. That's a booklet brochure that we can offer you. You can reach out at any time for that, of course. But remember that in order to trade options, you do need to be approved to do so on any account in which you would like to do so. If you have multiple accounts, you are capable of maintaining not just option approval, but option approval at various levels, depending on your process or your preferences. All right, so with that, let's get down to business. We're going to start with a look at how the broad market finished. And I mentioned today that the broad market had a little bit of that weakness today. So we're going to take a look at what we've gotten out of it. So we had a bit of a halt, if you will, at today's peaks, just shy of 67.50. We got through 67.50 a little bit here. If you'll notice on my hour-long bar, you can see that we got to 67.54, but then we just made a little bit of a pullback here over the last couple of hours. Now, the question remains as to whether that's a perfectly appropriate level off of which to get a bounce once more. And we've certainly been given a lot of those bounce opportunities. But I'm drawing in some short-term levels that I think a lot of traders are going to keep an eye on. First of all, remember that we rallied to this just shy of 6,700 level back here a few weeks ago. And that was on basically the 22nd and 23rd of September. And then we pulled back from that level and had to test support. And ultimately, that's what we did. And I'm going to draw that support line in here somewhere in this vicinity. And just it can be helpful to be reminded of a good monitor level for us as traders. I like to look at this on a daily basis. Many of you know, many of you will look at the 1 hour bars, maybe 4 hour bars. Find an intra-period time frame that seems to work well for you and gives you areas of note. You can do this, of course, on the daily chart. And some of you will say, even that's too fast for me. I don't want to look at the market that quickly. And I really wouldn't blame you for that. So be just comfortable trading in your time frame associated with the trends you're watching. So I've set those same lines in here, and you can see that while if we were to trade under 6,700, the next level of potential support or an area where traders may expect to get a bounce, it might be right here around that 20-day moving average. And then you happen to look at some of those horizontal levels that we see in here again. And one of those is right here, equal to the 20-day moving average, right? So there's always going to be some levels against which a trader might choose to base exit strategies, might choose to layer some of these exits. And I realize, and I hope a lot of you do as well, that these shorter term levels are probably too much for many traders to monitor, because while we might get bounces in here due to the strong enthusiasm we've been witnessing of late, that doesn't mean every trader wants to fall back on these shorter term levels and manage their trades in such a way. So, the one thing we can say about the S&P 500 going back to when we recaptured the 20-day back here on April 23rd is that the 20-day has been the most important moving average along the way. And that's because the only two instances beneath the 20-day moving average have resulted in subsequent higher highs. Okay, so that's the key component to remind ourselves of, is that short-term breaks of the 20-day have been your opportunity to this point to participate in the uptrend rather than use it as a tool for exiting the broad market. Okay, so for now, I think a lot of traders are going to continue to watch the same thing. And then a change to what's been going on here would be significant if we were to trade under the 50-day moving average. Today, that number is 65.10, as you can see in my on the right-hand side of this chart. 65.10 in purple here is representative of that 50-day moving average. And so trading under that might be a possibility. Maybe we get an intraday move down to horizontal support, prior highs, potential former resistance, now potential support. That could be the level there between 64.85 and 65.10, something like that. As always, thank you, Wiley. I always appreciate it when you mention some of these concepts like the so-called Horner rule, just adhering to a set of rules for yourself. What is your confirmation? Those are the types of things that can be very important to making our decisions quickly and in the moment, and also doing so without emotion, which is one of the most important aspects for technical or active traders, I should say. So the S&P, we'll see how this bears out, right? We'll talk about this tomorrow morning in Trader Talk and see how things kick off. But would anyone be surprised to get a little bit of weakness just based on some of the extended bullishness we've seen? We could get a weak open that maybe takes us to the 20-day, and then suddenly we start to see more optimism, traders looking for their chances to participate. There's been a big push in buying the dips every step of the way. Eventually that's going to change, but until it does, many traders just kind of stay the course until they see that evidence come into play. Now, the NASDAQ's going to look a little similar. Today, we made a new high and engulfed the entirety of yesterday's move. So maybe we've got a little bit more bearishness here in the NASDAQ 100. As we pull down, we've made a trade and a close below yesterday's low. Which, yesterday didn't make the high. Technically, today made the high. So I guess a close tomorrow under the 2479 area would be perhaps indicative of a continuation pullback, perhaps to the 20-day moving average. We've been above the 20-day now here since 9/4, September 4. So about 5 full weeks here, everybody. So keep an eye on the 20-day as it relates to the NASDAQ 100 as well, because a break there could bring the 50-day, and then you start doing those mathematical calculations, and it looks like about another 2.5 to 2.75% if we found the 50-day moving average there. The Russell today made a bit of a more significant move. Yesterday high, intraday, today a big candle to the downside, well below the high, the low of yesterday, the close below the low of the high day in this rally. This could be the indication of pause finally. You know, the Russell 2000 has been very, very strong, certainly all the way back to August 12. Almost what would be 2 full months here next week. So about 9 weeks right now, or 8 weeks, right? Almost 7, 7 weeks right now and almost 8. But again, a pullback to the 20-day wouldn't be all that shocking, would it? The big deal here is about the importance of the level that we've rallied to, because movement through 2,500 with any conviction could mean a bit more upside in the small caps, but perhaps just a little bit of a pause in the short run. We'll see to what extent the selling might continue the remainder of this week. Now, as I said off the jump today, we're going to utilize some of this bearishness to discuss some alternate scans that I've built for you, which basically started with my standard 20-day moving average pullback or my standard 50-day moving average pullback, but instead said, let's look for stocks that are rallying into the 20-day moving average and failing, or rallying into the 50-day moving average and failing. And the reminder I'm going to give you when I show these watch lists is that they're not always going to be set up for the next morning. And I realize that this class is kind of designed to help you set the table for the next day, but there's going to be a couple of potential examples that'll jump off the screen for us here. But we're going to work our way down the list, and we're going to listen to Kev's involuntary responses to some of these charts and see if we can find a bearish opportunity. One thing I have not done with this scan on the 20 or the 50-day, everybody, I have not defined it as anything other than being a member of the S&P 500. So let me just bring back the 20-day scan here. I'm going to go into load my query. So I'm doing what I've called the bearish 20 DMA test and fail. And I'll hit the scan on that. And so that's what's in my watch list here. But the detail is I basically am looking for a move that has come into the 20-day moving average, and the stock's going to have a 50-day moving average that's below its 100-day moving average, which means we are likely looking at a downtrending security. The intermediate time frame being the 50-day, the longer being the 100-day. If you want to add some additional components, some traders might add in something like the 20-day simple moving average being beneath the 50-day simple moving average. Again, finding downtrends in multiple windows of time. Now, I will share this one with you. The two big key components here is that the intraday high today needed to be above the 20-day simple moving average while the close was below it. Okay? So let me go ahead and share this scan query with you. And please be reminded that our scans, when we share them, are not guaranteed for your for accuracy. They are not guaranteed for timing, and they are not a recommendation for your use. But I'm sharing them as an example and to give you something that you could consider working with. Please also consider playing with the criteria here. The more you customize these screens to meet your own personal needs, the better off you likely would be. So this again is the 20-day moving average bearish test and failure. So let's look through some of these charts and see what we have here. We've got, I'll start at the top. We've got Ball Corporation. Okay. So here's a decent example of a security that's been working against a 20-day moving average. Today, you had it, well, for the last week, you had it above the 20-day moving average, and then today really took it out beneath it. This could be a candidate for a short or a bearish trade Considerations might be something like a long put vertical here, whereby the trader believes there's going to be more downside action and they want to speculate on that. They might buy a put to speculate on that move to the downside and subsequently, or at the same time, be the seller of a put at a lower strike price, building in a risk-defined put strategy. So vol is in a downtrend, and you've also got an intermediate term scenario playing out with a 50-day moving average crossing the 200 to the downside, what some traders would call the so-called death cross. Let's move. We'll keep moving on down the list here. Here's Baxter International. Baxter has actually been, boy, I'm going to actually put a little star next to Baxter here because this one's been in a downtrend and it has tried a little bit to get out of that downtrend here with some action along the 50-day moving average. But boy, it rallied into this zone of right around 25 approximately, and it just didn't have any chance to get through it. You could see it banged its head on resistance there. And then now what you've got was a test and failure of the 50-day just yesterday. If we zoom in to what we see here, and let me just kind of reposition the price action here. So what do we have as a potential scenario to play out? Well, looks like our lows are right around 21 and a quarter, and we're trading around 23. So we're in a range, and given the nature of the price action here, fail at the 50 followed by a fail and a yesterday close below the low of the high day, some traders might have gotten going in earnest on this one yesterday from a bearish standpoint. Well, today you also validate yesterday's action by trading below the low of even yesterday. So this could be a situation that plays out bearishly going forward. Might also be a nice setup from an example standpoint for a long call vertical, a long put vertical, I apologize, or could be maybe the trader wants to sell a call spread above the market value here, trying to reap some premium, not believing that there's opportunity for upside. So that's kind of what you see developing here. It's still early in this breakdown. The other case, the other way to look at this could just simply be a long put vertical from where we reside right now, and then the trader determines whether or not to cover down here around 21, or if there's a possibility the stock is going to trade under 21, well, then we have the potential to see a larger breakdown equal to the height of the range that we're monitoring, which is basically from 25 to 21 approximately. So we could see a potential for a more significant break if it can trade under 21, equal to the height of the range that we would break in such a case. So that's why you might be looking at it like so. All right. So that could be an example trade for us. We'll keep working our way on down the list. Here's Celanese, also appearing to fail at that 50-day yesterday with the close below the low of the high day. So make note of that. We've got CME Group here. CME Group has been doing pretty well, but it's pulled back to a major moving average. This one looks a bit different than the others, right? Because we're on the 200 as support rather than on the 200 as resistance. So this stands out and would probably make it to the sidelines in this bearish 20-day moving average, much more likely to be a potentially a bullish opportunity. So we'll just keep moving. Here's where you've got possibly something on the works for as early as tomorrow. Cognizant Tech, CTSH. Now, we have seen some of that bearishness in tech a little bit today. So maybe a trader looks and says, well, if bearishness is going to come into technology and I want to trade bearishly, maybe I should look at some of the tech securities that have been bearish, because if the rest of tech that's been doing so well is suddenly in pause mode or pullback mode, then often the leaders to the downside continue to stay leaders to the downside. So this could be setting up for what might potentially be another bear strategy. And I'll note here that, you are at the 20-day moving average with today's price action. But notice we were right through it today and then came back and closed below it. So it could very well be that so-called test and failure right here. And so maybe we set up a bearish continuation trade here again, looking on the put side, and maybe considering more downside as an opportunity. And I'll also remind us, one of the key things we got to do, it can always make sense to double check that what we see in the daily chart makes sense on the weekly chart, everyone. And what's significant about this to me is that there is a layer of potential support beneath us should the one we just drew in here not hold. And so you might look back and find that either at this last low, which is right around 64, or the level we had to move through right in here so that we could start getting bullish again, and way back when, and into basically the fall of 2022. But this level here might be the most important aspect for that if we were going to see a continuation move. So that's around 63. Now, this also could just mean that there's not a whole lot of lovely opportunity here. It's a kind of a tight price level, 68 down to 63, only 5 points, but that might work for some of you in your trade details. So keep on moving along here, everyone. I'm just looking for something to kind of jump off the screen at me as a potential bearish one, and this one kind of stands out actually. Microchip. Let's see here. We've got lower highs, excuse me, right? Still lower highs. You got a top that tried to hold and couldn't a couple days ago, and that turned over. And then yesterday, let's zoom in here. So yesterday you had this successful 20-day moving average test, and it rallied at the close. But then today we've basically kind of sold down broad market weakness. So, this might be one where the trader wants to trade it only if it trades under the low from yesterday, perhaps. And maybe we revisit the 200-day moving average. Maybe about a $5 move, potentially. That could work out. And one of the things that stands out here when I'm looking at this, as we have failed here and here. So big tails when we got through that downtrend line that then resulted in the pullback or the rejections. But also notice that our rally the last time in the RSI, both of these instances only got us to the 55 level. And why is that significant? Well, if you've been attending these shows with me, you know that I speak to this stuff kind of frequently. When we use RSI in range-bound situations, we consider that the overbought condition comes from the RSI above 70, and oversold comes from RSI below 30. But in a bearish sentiment view, if the stock is not in a strong trend, or is in a bear trend, like we might be seeing right here, traders might expect RSI to get no higher than about 55, and that to be considered overbought condition. So if RSI is in overbought conditions and the stock is rallying into resistance and then fails, some traders would look at that as the beginning of more bearishness. And by making a lower high in this instance, the setup might suggest thereafter a lower low. Okay. And so if it were at best a matching low, well, then we might look back here at those last lows we made, which were just shy of 61. And of course, if you're looking at 61, why wouldn't you just look at the 200-day moving average, which is around 59 3/4 ballpark? So that's, that should give you an approximation of something for consideration. That could easily develop into more bearishness. And if it doesn't hold the 200-day, then that bearishness becomes even more pervasive. So let's get into placing a trade on something like these. Oh, there's an interesting one on McCormick. I mean, we've now today just gave you a pretty clear multiple tests, right? That's number 2, there's number 3, and then today, and today would be number 4. If we were prepared today for this one, everybody, this one might have been the one, because wow, intraday for it to get through the 50 and then just completely reverse course, boy, and take out failure at the 50 and then take out the 20 with some conviction intraday. That's kind of notable. And then the last thing is just to check that. How does that look? Where could we go? Well, probably just too tight, but I guess the trader would have to think, everyone, that you got to get down to test those last lows if you're looking at this one making sense from a maybe a deeper trade opportunity. And that's because we're trading at 66.5 or 65.5. And if we only think it can drop to the last low at 63.5, it's only $2. And I'm not sure that that's worth the time of the trader. So why don't we build a trade here in McCormick based on the belief that a trader might have that says we're not just going lower, we're going to make a new low based on those longer term trends. And that's my white line there at around 60. Okay, so let's think about this. If you're a trader who thinks McCormick is going lower and you want to incorporate the use of options, you might want to incorporate a higher delta long put, meaning a contract that's going to move in a higher relationship to a $1 move in the underlying stock. So if we're thinking like so, we'll go to the trade tab. We will go to, whoops, that purple. There we go. So we'll go to the trade tab and let's go, well, we've got 2 weeks here, 10 days. So let's go ahead and use that one. Let's see if this is a short-term trend. So we'll consider a short-term bearish trade. And we know that the 50-day moving average at which we failed was shy of 70. So this points to using the $70 long put and maybe the $65 short put. So entering in to a $5 bear spread, a long put spread. And why would a trader would they be comfortable at that 65? Well, all this says is that the trader believes that between now and next Friday's expiration on the 17th, that the stock would be under $65 a share, in which case this trader can spend about, let's call it $375 to put this one on. And the reminder I have to give you here, if we're the buyer of a long put spread, we can make the difference between the strike prices, in this case, $5, less what we spent. So we could spend $375 for the opportunity to make $125. Now, many of you would say, but Kevin, that doesn't make a lot of sense to me. I'm spending $375 for the opportunity to make $125. And I'll just remind you that the 70 put has a high likelihood of being in the money at expiration, a 78 delta, which also says that it's 78% likely of being in the money on expiration. The 65 strike has a 40% chance of being in the money at expiration. So we are looking at a higher probability factor. Okay, so that's why a trader might consider something like this, believing that there's more downside here. Now, obviously, we want the stock to be under 65. It doesn't have to make a whole lot of move for that to happen. What we ultimately get from this is a short-term bearish trade that could play out quickly if the stock follows the path that it's been following today, as it failed basically against that 50-day moving average. So we'll go ahead and we'll build this one, and then we'll go look at another one real quick and see if we can find something that might be a little bit more of a less risk for the opportunity. But really, if nothing else, the trader here should still be comfortable, right? If you're comfortable losing $375, well, that becomes essentially your maximum loss, assuming we don't take any action with our long put. So All right, so here we are buying one vertical put spread. We're going to own the 70 put. We're going to sell the 65 simultaneously. It's going to cost us $375 to put it on for a max profit of $125, max risk of $375. There we go. Go ahead and send that one through. And then I have that other one. Let's look at Baxter for a potential similar trade. All right, so here on Baxter, we had that upside at 25. We've got the downside match at around 21. So here that we have a $4 spread, we might be able to make this a little bit more cost effective. Let's see if we got it from a 2-week standpoint. Looking at the 25 for 225 and maybe say the 23. Now that's not going to work out too much, is it? See that we're still spending $1.48 to make 50 or $1.50 to make $50. That's a little bit, very similar to what we just saw. What if we added more time though? So instead of 10 days, let's make it a month. Let's go to Halloween. And let's think about this from the exact same process. Of course, you've got some wide spreads in here. We won't want to go with the 25. Look at the open interest. So very tight open interest. This is not nearly as appropriate based on that. There is open interest at these lower strike prices, and we could go out the money, but you know what? These just aren't speaking the way that a lot of you traders would look. Meaning you want to have, we often say it as traders, whether options or equities, you want to be a little fish in a big pond. You want to fish where there are lots of other participants. There are a few out here, but these numbers are not inspiring, unfortunately. I was looking for something that would kind of jump off the screen in terms, the pattern looks bearish, but the dollars and the number of trades involved here, the lack of open interest is kind of leaving me a little less enthusiastic. Let's see if we've got anything else that could work in this way. Well, maybe on semi, because on resides in a very actively traded space. If a trader felt like you could get this one under, say, 47, there might be a decent trade, and there still is a bit of a downtrend. You'll notice the failure at the 50-day here. What if we looked at $50, maybe like a $5 bear put spread on this one as well for just the next couple of weeks? Let's see here at 50 for 286, 45s for 54. That's a little better, everybody. We're looking at spending $225 to make $275. That might make a trader feel a little bit better from a $5 spread scenario, risking $225 to make $275. The reason here, this is just got a little bit more. Look at the open interest, obviously here, everybody. The 45s got a bunch of open interest at 3,300. The 50s have 4,300 open interest. This might make a little bit more sense from a trade standpoint. So let's take just a quick look at 50. So 50 is coincident with the 50-day moving average, and 45 is below us. So yeah, we would have to break this last series of lows, and then we might be looking at around 42 as a next potential level here. But you don't need to be profitable, that you don't need this one to stay under necessarily 45. It really just needs to stay under your break even, which would be the $50 less 225. So 47.75 by my quick back of the napkin math there, everybody. And also, once more, look at your RSI. Your rallies of RSI have been to 50 to approximately 55, right? Not really above it. 57 was the highest it got. So this looks like bearish sentiment or bearish behavior relative to the RSI. So this one could work as well. We'll put this one on as an example of another bear put spread. Long the 50, short the 45, entering into that agreement for a $5 spread. and we'll do so if we can get in for 225. So let's go ahead and confirm and send there, and there's our details. Max profit 275, max loss 225, equal to our cost. All right. So now that we're about 10 minutes out, let's make sure that we review our example portfolio. We have to cover our example trade here in Crowd. CrowdStrike has been doing wonderfully for us. Look at this. We built a long call vertical spread, bought the 430, sold the 460. The stock remains above it, 484. That's 24 points above our short call. Now, because we let this one go a little bit, we are much closer to max profit on this one. So we're going to go ahead and place a limit to create the closing order. So I'm just right-clicking on this in Create Closing Order to sell my vertical spread. And I'm going to take the going credit here. The mid shows is 27.37. I'm going to just reduce that by 37 cents because I don't want $37 to be the difference in me getting out of this trade. So I'm just going to say take $27 limit or better, and I'll be happy to move on. So I'm going to go ahead and hit confirm and send on that one. And hopefully that one gets closed out for us tomorrow. But take a look at how it worked. If I put my trades back on here, I'll just show you real quickly. Oh, I thought it was going to highlight my actual. Oh, it didn't highlight my trade because it's an option trade. So let's see. Should have done that. But ultimately, you know, we got into the long call spread on let's find the trade date here. August 29. So this one really didn't sit very long, right? I mean, we did about a 6-week window. August 29 was back here on, it was on the breakout, the day after the breakout, or the day of the, okay, so we bought in, we talked about it, that is to say the Thursday, August 28th, we set a buy order up based on that breakout candle that closed above the 20-day. And then the next day, you can see it had a bit of weakness here with this red candle, and we still traded down to the 200-day moving average. But we had enough time associated with our long call vertical spread that we didn't really need to concern ourselves with anything. Notice how the stock traded at the 200-day moving average for those 4 days. Lots of tails through the 200-day, closing above the 200-day while intraday trading below it. A wonderful example of stock coming down to an area of support and needing to dance on that area of support a few days before moving off of it and rejoining this new uptrend, right? But a very interesting move from here. It worked out in our favor, and hopefully we'll be looking to close this one tomorrow for a max profit. Let's also check in on our Globe Life GL. That's just an underlying 100-share equity position. We're down a little on it today. We have a stop order in on this one. This is crazy, everybody. I went back and I reviewed it to make absolutely certain how I did this. I put this on and I chose, so we bought it back here, and we chose to come beneath a level of what we determined to be support, and it was this last low at 134.64. And I said, well, let's go to 134, and then I just hit beneath it. I just, used the adjust the trade below. I just went 3 cents beneath it and selected the stop of 133.97. Yesterday's low was 133.97. Couldn't get much closer to a stop out than we did yesterday. We did not trade through it, so we did not get stopped out. Maybe it stops us out tomorrow. Didn't happen today. Today you got a bullish harami, a day fully engulfed in the prior day's action. If we can move off of this, maybe that stop holds, but we are in precarious positions. The reason I'm talking about it today, though, remember, when you place a stop, we do not reduce our stop orders. We maintain the level we set initially. If the stock gives us a reason, an opportunity to elevate or raise our stops, we take advantage of those. We do not reduce our stop price, though, because that adds more risk to the trade than we initially considered. We don't want to do that, right? Okay, so Globe Life, we're not making any changes there. That's going to sit and do what it's going to do. We did last week put on a trade in Medtronic. We bought 100 shares of Medtronic on a breakout. Well, we got that breakout, everybody. In fact, the trade was a buy stop if we can trade through that 96 level, and we got exactly that. So we have a trade on, we have a stop order in. The only question is whether the trader wants to elevate that stop right now. This stop is below both the breakout level, which I'm going to change to green to validate it as a potential support. It's also above the 20-day in orange, potential support, and above the 50-day in purple, potential support. So we will maintain the existing stop. However, some traders out there in this position today might choose to elevate that stop to just below the green line, maybe just below the 20-day, or if they say, you know what, I really like this, but I don't like the outright doji today, the open and the close on top of each other, the indecision. Some traders might say, let's raise that stop to the low of yesterday or just beneath it in an effort to not risk profits. And I'm seeing Gary and what, all right, you guys, you're in charge. We're going to raise it. We're going to go ahead. We're going to put it right up to just beneath the low we made yesterday. All right. Now, today is the high of this rally. So perhaps we trade quickly through this and get stopped out. But if we got stopped out, well, the hope is we still walk away with a few bucks of profits. Never a problem doing that. I need to remind you, as a basic stop, this triggers and becomes a market order to sell. That means no guarantee of price at which we could sell once triggered. So just please be aware of that. But we've elevated it. Happy to do that for you, Wiley, for Gary and R1, taking some profits. Since the market's closed, we can't take profits right now anyway. So let's just raise our stop and protect ourselves, or at least make an effort to protect ourselves. All right, we're going to have to wrap it there, everybody. As always, love having you join me for this particular session. I'm glad we're here now going forward on Tuesdays at market close, 4 p.m. Eastern. This will likely eliminate many of the instances where I've not been able to join you due to my in-person event travels. So follow Barb and me on X at Kevin Horner CS, at Barb Armstrong CS. If this discussion was helpful for you, please hit that thumbs up button down below. That'll help us out greatly. And don't forget to meet us there on X. We'd love to see you. So have a great rest of your Tuesday, everybody. I look forward to catching up with you again real soon. I will be back as early as tomorrow morning for Trader Talk, and that'll be at Market Open. Have a nice night. Thanks, everybody.